Well, hello, and welcome back to Principles of Accounting 2. I'm your host, Dr. B. Today we're going to be talking about differential analysis and product pricing. One of my favorite topics as we discussed differences in revenue and cost, and we'll also talk about strategies to price your products correctly. And you'll probably realize some of these strategies because uh, you've seen them before. You've seen them in the stores. When you go shopping, you're like, oh, I wonder how they decide these types of prices. We'll talk a lot about that. It's actually one of my favorite topics. And before we get started with today's lecture, I do want to highlight where we are and where we're going. We're in week 13, if you can believe it or not. Chapter 25. Wow. Wow, wow, wow. Oh my goodness, time is flying so quickly. So let's talk about where we are. So for this week, as we explore the concept of differential analysis and product pricing, you'll have a discussion board. Now, I would like to politely remind all of you how discussion boards work in this course. There are 4 discussion boards in total. Each discussion board is worth 5% of your total grade. If you do not decide to participate in this discussion board, you will automatically drop a full half-letter grade for the course. So please, please, I am trying to encourage all of you to participate in the discussion board. Uh, Now, as you participate, to earn the full 5 points, you need to have full paragraph responses, okay, to the discussion
Hello.
prompt. Yes, Tamika. Tamika, did you have a question? Accidentally unmuted. That's okay. Uh, So as we go through the discussion board, you'll respond in full to the discussion prompt with a couple of paragraphs, paragraph or two. And then you'll respond to 2 of your classmates with full paragraphs, not just, oh, that's a good job, oh, I like your response. Those aren't responses. No, no, no. Full paragraph responses to your classmates. Please, please, please. Otherwise, I'll for sure dock you on that. Yes. Um, so as a reminder, full paragraph responses for both your original post and full paragraph responses to your classmates. That makes a discussion. And remember, a discussion can't just be with yourself. It has to be with other people. Any questions on the discussion boards? We're good. Okay, wonderful. So that's the discussion board. If you have any questions, please let me know. So, in the previous week, you've all completed your Chapter 24 quiz. Well done. And then before that, you had your Chapter 23 homework. And then all the way back in week 10, you had your Chapter 22 quiz. So when we're in week 13, very impressive. What does that mean? Oh my goodness, we're approaching the end of the semester very quickly. Uh, some of you are graduating this semester. What that means is you need to complete the final exam pretty much by the last day of the course. The last day of the course is scheduled for uh, April 24th. So also April 24th, you'll need to have your final exam done if you're a graduating senior. If you're not a graduating senior, your exam date will be May 4th. But my recommendation is to try to get done by April 24th. It's already open and available, okay? If you're one of those, oh, I just want to finish up and get it done, feel free to work ahead. That's totally
Professor
fine.
B,
John,
not to interrupt you. So you said the graduating seniors have to do it by the 24th?
that's right. Yeah. And
By
then
the 24th. Okay, you
yeah,
said it's already open.
it's already open. Absolutely. So
Oh,
if
okay, so good.
if
Okay,
you're
great.
if you're feeling so ambitious, which I know you are, and you
Yeah,
want to work ahead, I've
I
seen you
have
do
I
it.
have been working ahead. That's exactly what
I
I had
know
been
you have.
doing, and I found that it just made my life so much easier. Like I'm a little ahead, so I got to go back, but I'm where I need to be.
You're where you need to be exactly. Now, John, I will remind you. Just make sure that you do participate in because I believe there's two discussion boards remaining, if I'm not mistaken. There's a one for this week, and I believe there's one in the final week. So just make sure that you do go back and you respond to your classmates after you
Yeah,
complete.
it was one I was waiting for more people
I know you
to
were.
put post theirs. That's what I
That's
was waiting
fine.
for. So I am going to go back and do that. And then it was one, and it was another one that I did miss. I did go back and do it, and I did answer to two
I got you.
classmates. So I was wondering if
I'll update your grade.
you
Absolutely.
will update it. Okay.
I got you for sure.
Okay.
No
Okay. And
worries there.
I'll definitely go back and see if I haven't missed none. I
Yeah,
don't know
just
if I yeah, I'm gonna
go
just
ahead and look
stroll
at it.
up. Okay.
Absolutely. Absolutely. I got you. Yeah, so if you want to go ahead and work ahead, you're more than welcome. The final exam period for graduating seniors is April 19th through the 23rd, technically the 24th. So as long as you take that final exam by the April 24th for graduating seniors, you're good to go. And yes, it is open and available for you to take now. So if you're one of those few that loves to work ahead, you are more than welcome to go ahead and do that. Having said that, what's remaining? We are currently looking at Chapter 25 today. We're in week 13. There's a discussion board that is due by Sunday night. My recommendation is to have your original response done by Thursday night, so that way your classmates will have the opportunity to respond. That's really what makes a good discussion. Next week, you'll have Chapter 26 quiz, and we'll talk about Chapter 26. The following week, week 15, we'll have, now week 15 is a busy week, okay? We have two chapters that week. Now, here's why, okay? So, and I can already hear you, oh, Dr. B, you guys, you're trying to kill me. This is crazy. Two chapters in a single day, I don't know if I can handle that. Yes, you can. You can handle it. I know you can. Which in week 15, we're going to do chapters 27 and 28 on the same day. That'll be a long night. It is our last night, however. And having said that, we'll power through. 27 and 28 are very short chapters, very short chapters. So don't worry too much about that. And the reason why we had to do it that way is because, again, some of you are graduating, and we had to make sure that we covered all of the content. Very important. So, any questions before we start? We're okay? All right, wonderful. Let's go ahead and jump down into it. So, chapter 25, differential analysis and product pricing. Again, one of my favorite topics. The reason being is because I like to look at data and understand the differences between revenue and cost prices. And I also like to understand that my company is appropriately pricing our products to where we'll be able to generate profit. Very, very important. So let's talk about what is differential analysis. When you hear the word differential, it means the difference. Very simple. Very simply put, it means the difference. Okay? Differential analysis, we sometimes call this incremental analysis. That's the other common name for incremental analysis. But differential analysis, so we look at the difference. And when we talk about difference, we're talking about not only the difference in revenue and expenses, but we're also looking at the difference on the impact of two courses of action. What that means is sometimes I'm faced with a decision. There are two decisions. I can either choose path A or choose path B. Okay? And when I'm faced with that type of decision, I look at the difference between the two decisions and what the impact will be on my profit. Okay? Uh, and one of those decisions, we call it the make or buy decision. It's where we either decide to make our own product or buy another product and then resell it. That's one type of differential analysis decision. Other decisions would include things like lease or buy. It's where we either lease a a piece of machinery or buy a piece of machinery. Same, you can make the same decision for your car, for your house. You can make the decision to either lease or rent or buy. And so that those we can look at that from a differential analysis. What is the impact on the profit? So as we make those decisions, we first look at the difference in revenue. Is the revenue expected to go up or down based on the alternative courses of action? Uh, and then we also look at the difference in cost. Is the cost expected to go up or down based on the alternative courses of action? Which leads us to the difference in profit or loss. Revenue goes up, if revenue goes up and our costs go up, as long as our revenue is greater than our cost, we'll have an increase in profit. If revenue goes up and cost goes down, that's even better. That means our profit went up even higher. If the opposite is true, if our revenue goes down and our cost goes up, that means our profit has shrunk. And so after we've looked at the differential for revenue and the differential for cost, of course, it's going to be a differential for profit. So the way to think about differential analysis is look at two potentials for your revenues and your costs, which will mean there will be a difference in profit. As you know, on the income statement, we have our revenue minus our expenses equals our gross profit. And because of that, as revenues and expenses change, we know that there'll be a change in profit. And the concept of differential analysis is we're looking at two different types of decisions, decision A or decision B. And what is the difference between the two? What will be the impact on our profit? So let's take a look at an example. Some of you are hospitality majors, so you will enjoy this example. Let's assume that we have a restaurant, and our restaurant is trying to make a decision to remove some customer seating and replace the customer seating space with a salad bar. And we can run what we call a differential analysis to help us make this decision. So here we have alternative one. Alternative one is we leave our tables where they are, okay? Our revenues are expected to be 100,000, our cost will be 60,000, our profit will be 40. Alternative two is we remove some customer seating and install a salad bar. We expect that if we do that, our revenues will increase by 20,000 to 120,000. Our costs will also increase by 5,000, and our profit would be expected to be 55,000. So what we do is we perform what's called a differential analysis. When you perform a differential analysis, it's very simple. We're simply taking the difference between the two alternatives. So 100,000 minus 120,000 gives us a revenue increase of 20,000. Our costs, we can see the difference between the two, 60,000 and 65,000. Our costs increased by 5,000. So to find the difference in profit, we can either go across, right? We could do alternative 2 minus alternative 1, or you can simply go revenue minus cost equals profit. So revenue difference 20,000, cost difference 5,000, profit difference 15,000. So 20,000 minus 5,000 equals 15,000. So based off of this differential analysis, which decision would you make? What do you think? Who wants to go? Andre? Andre, what do you think? Which of these two decisions do you think is the best one for the restaurant?
I'm thinking that it could probably be salad bar.
Why would you say that? What do you think?
Salad, as in like they lost a lot more profits, but I mean, two cents.
Yeah, no, that's a good reason. So if you look at the salad bar, we increased revenue by 20,000. Our cost went up a little bit, but we gained a little bit in profit. So yeah, I would agree with that logic. And I think I would make that same decision. I think I would install a salad bar for that additional $15,000 in profit.
What threw me off is that I saw it was a profit loss next to it. So I was like, wait a minute, profit is that we 55 that we gained. So if it looks like we gained it, then it's something that it's a positive.
Absolutely, absolutely. So if you look at the third column here, the differential effects, which is the differential analysis, we increased revenue by 20,000. We have a small increase in cost of 5,000, and we increased our profit by 15,000. So having said that, since we increased our profit by 15,000, I have a feeling that salad bar is a good idea. If I were the restaurant owner, I would definitely install a salad bar. And so, and that's how a differential analysis works. You have alternative one and alternative two. We look at the difference in revenue and cost and profit between the two alternatives to make a decision uh, between the two alternatives. And that's what that does. That's the whole concept behind the differential analysis. Um, and that's why we do that type of decision tree, right? So we're looking at two alternatives. We compare the two alternatives based on revenue, cost, and profit. And when we do that type of differential, and I'm sorry, when we do that type of differential analysis, we can see that installing the sale bar is a good idea, or, or whatever the decision is a good idea if the profit ends up going up. Even if the costs increase a little bit, which I would expect that to happen, um, it still ends up being a good decision if your profits ultimately increase because of the decision. So it's very simple steps. You look at the difference between the revenues. Then the second step is you look at the difference between the costs, and the third step is you look at the difference between the profits. And you can simply subtract across, or you can go downward on the column. But either way, you'll get to the same result. So based off of the decision, yes, installing that salad bar would be a wise decision because it would increase profit by 15,000. And of course, the revenue goes up. So, and all of those are, of course, increasing profit's a good thing. That's the whole reason why we're in business, right? And we can make this type of decision a number of different ways. This differential analysis can be used for deciding between leasing or buying equipment, replacing fixed assets. That's the good old repair or replace, right? Discontinuing unprofitable segment, manufacturing or purchasing, accepting additional business at a special price, selling a product or further processing it. There's all different kinds of decisions to be made using differential analysis. All it simply is we look at option A versus option B. We compare the two for revenue, cost, and profit. It's a very simple concept, and at the same time, it is very useful. It helps us as managers to grow the profits of the business, potentially, right? Another example would be the good old-fashioned lease or buy decision, or lease or sell decision. Uh, lease or buy, lease or sell, same concept, right? Um, let's use a printer for a copying machine, for example. Let's say I have a copying machine or a piece of equipment that I no longer use. I can lease that piece of equipment to another company, or I can sell it on the open market. And differential analysis can help us in that type of decision. So here we have some information. We have a piece of machinery that we are considering to lease or sell. The cost of the machinery originally cost us $200,000. And I've been using that piece of machinery for a couple of years now. And I have accumulated depreciation of $120,000. That gives me a book value, current book value of $80,000. 200 minus 120 is 80. Okay, so a couple of decisions here. I have two options. It's currently worth $80,000. So in other words, I purchased a piece of machinery a couple of years ago. I've been using it. I no longer need it. So I can do two things with that piece of machinery. I can either lease it or I can sell it. Okay? If I decide to lease it, I can generate potential revenue of $160,000. And it will cost me about $35,000 in repairs, insurance, and taxes throughout the rest of its useful life. And that has a residual value of 0 at the end of the 5 years. Alternative 2 is I can simply sell it outright for $100,000 and I can make a commission of 6%. Okay. Based off of this information, what do? Well, it's a tough call, but here's how it works. Alternative 1 is we lease it. Alternative 2 is we sell it, and we do a differential analysis. Based off of the lease, revenue, $160,000, cost, $35,000, give me a potential profit of $125,000. Alternative 2, sell it, revenue, $100,000, commission cost, $6,000, which is 6%, giving me a potential profit of $94,000. Using the differential analysis, I look at the difference between revenue, the difference between costs, and the difference between profit. Difference between revenue is $60,000. Alternative 1 is clearly the better option when it comes to revenue. Costs, a difference of $29,000. That means I could save $29,000 if I just sell it. Okay? The difference between the profits, alternative 1 and alternative 2, is $31,000. So, Ms. Smalls,
Yes.
which of these two alternatives would you do if you were the business owner in this situation?
I was looking at alternative 2, but I'm not too for sure because I think I missed something in the previous lectures when you was discussing. I ran to the bathroom. So I think 2.
Well, I wish you were
Okay.
right.
It's wrong.
It's
So
1. It's
it's
alternative 1.
alternative 1.
Yeah,
So
and the reason why,
okay.
Ms. Smalls, is because you would have a greater potential profit using alternative 1, which would be to lease your current equipment to someone else. So revenue minus cost equals profit, as you know. If we do we're using differential analysis, the objective here is to look at the differences between two alternatives. Looking at the difference in revenue, my revenue would be $60,000 higher in alternative 1 than it would be in alternative 2, which would tell me so far alternative 1 is the better option. The difference in cost is $29,000. The cost is much higher in alternative 1 than it is in alternative 2. Okay, but then you get down to a profit or loss. Okay. Alternative 1, my profit would be $125,000. Alternative 2, my profit would be $94,000, giving me a difference of minus $31,000. Okay, so
I
looking
get
at
it.
you kind of get it
I'm sorry.
now?
Yeah, I'm starting to see. Okay. I
Gotcha.
thought the profit was lost, so I was thinking the lease was the okay. But I see now.
Gotcha.
Okay.
Wonderful, wonderful, wonderful. Okay. So we're not, I mean, this is a good analysis. It's not quite complete because you would actually want to, at this point, you would actually want to subtract out the book value. But to keep it simple, this is a good differential analysis. So revenue minus cost equals profit. Revenue minus cost equals profit. 160 minus 35, 125. 100 minus 6, 94. The higher of the two, the better, right? And so the higher of the two profits is the one that you go for. Because the idea in business is make the most profit. Okay, so that's lease or sell. Now, oh, here we go. This is where I wanted to get into it. Now, here's the thing. It's currently worth, the piece of machine is only worth 80,000 before I even decide to lease it or sell it. We call this a sunk cost because I've already spent that money. I can't recover that. It's already depreciated. I originally bought the piece of machinery at 200,000. It depreciated over a couple of years, 120,000. Current value 80. We consider this to be called a sunk cost. And we don't factor, technically, we don't factor that into our decision making. The reason being is because that 80,000 book value is not affected based off of either decision. Now, if you look back, if I lease it for 160,000, I don't care about the fact that it's only worth 80. Because if I'm trying to lease it out for 160, they don't even know it's worth 80. Or if I try to sell it for 100, they don't need to know it's worth 80. You know what I mean? So what I'm trying to say is that because we've depreciated the original piece of machinery by 120, we don't take that depreciation into consideration when we make a differential analysis. Because it's not going to make a difference. Call it a sunk cost. Happened in the past, can't be recuperated. And it's not going to affect future decisions. Sunk costs. Think of like, sinking a ship. The ship sinks to the bottom. Well, you just lost the cost of that one. You can't recover it. That's why they call it a sunk cost. Okay, now, what about the decision to discontinue a segment or a product? As you know, over time, things become obsolete. A product becomes obsolete. It becomes no longer worth to sell it. The costs become too high. There's a number of reasons why we would discontinue a product or a segment. It becomes obsolete, price goes too high, parts become harder to get, customers no longer want it. The list goes on and on and on. So we need to make a decision to discontinue it. And so how do we make that decision? We do it through differential analysis. But one thing important to note, fixed costs cannot be eliminated. So even if I decide, hey, you know what, I'm no longer going to sell this product because it's not doing well for whatever reason, I still have fixed costs. The business still has depreciation, insurance, property taxes, rent, etc. Salaries, right? The company still has fixed costs. So even if I decide, hey, you know what, I'm going to discontinue this product, I still have fixed costs to cover. So it's important to take that into consideration as we make this decision. So, Battle Creek cereal. Many of you know Battle Creek cereal as the Post cereal is the name of the company. Okay, Battle Creek, Michigan is where they're based. So here's some data that we have from our friends over at Post. We have Corn Flakes, Toasted Oats, Bran Flakes. And here's the data that we have. Our sales are 500,000 for Corn Flakes, 400,000 for Toasted Oats, 100,000 for Bran. giving us $1 million in sales. Okay. We have variable costs, which, as you know, are the costs of manufacturing the product, direct materials, direct labor, factory overhead. And we have fixed costs, supervisor salaries, depreciation, taxes, et cetera, et cetera. So sales minus total cost of goods sold equals gross profit. Minus your operating expenses, variable expenses, fixed expenses, total expenses. So gross profit minus total operating expenses equals operating income or loss. Now, looking at this data, quickly looking at the data, if you were the manager of Post Cereal and you had to make a decision to discontinue one of these products, which one would you discontinue and why? Who wants to go? Don't all answer at once now. Which one of these 3 products would you discontinue and why? Go ahead, Andre.
Bran Flakes. I'm gonna
Bran,
take a shot at Bran Flakes because I have like a negative loss of $11,000.
yeah, that's a good one. It's a good one to eliminate. I would think the same thing, right? Just quickly looking at the data, seeing that it's an operating loss of 11,000, and besides the fact it's Bran Flakes, I mean, who really likes that anyway? But let's take a look at your decision and see what happened. Okay, so here's the decision. Do we continue Bran Flakes or discontinue Bran Flakes? Now let's look, okay? This one's a little bit trickier. For Bran Flakes, we currently have a revenue of 100,000. Our costs are relatively high, okay? We have 85,000 in variable costs, that's very high, and fixed costs 26,000, giving us a total loss of 11,000. That's our current situation. Now, if we decide, hey, you know what? Let's discontinue the damn Bran Flakes because they're clearly not profitable and nobody likes them. So, alternative 2, discontinue. Revenue 0, because if you discontinue it, that means you're no longer selling it, which means 0 revenue. Fixed costs still exist, 26,000. Remember, fixed costs do not change regardless of the level of output. So fixed cost 26,000. So the differential analysis, revenue minus revenue, 100,000 loss. Variable, 85,000 difference. Fixed cost difference 0 because fixed costs remain the same. Total difference in profit 15,000 minus 15,000. So, Andre, looking back at your decision, would you still continue or discontinue the Bran Flakes, and why?
I would continue to discontinue the Bran Flakes because there's a there's a fixed cost of $26,000, even though I discontinued it, which is not going to change anything. The only thing that was changing anything, I guess, was the fact that I had it on the shelves and I was gathering revenue from it. But it wouldn't really make a big difference for me to continue it. But so I need to really discontinue it, I feel, because I'm going to have a profit loss of 26,000.
Yeah, so I agree with your logic. I think you have a wonderful argument, and if I were the owner of Post Cereal, I would probably say that's a great idea. But we would obviously need to replace that product with something else to try to generate a profit.
That's my question. That's where I kind of got confused a little bit at.
I'm
Was
with
like,
you on the logic, okay? I'm not saying your logic is flawed. I'm saying that the decision is incorrect. But I like your logic. Your logic is very sound. I would have made the same decision, honestly. But Since this is an accounting class and we're not in investing, we just look at the numbers. So
So
if we look at just the profit, minus 11,000 versus minus 26,000, which one would we choose and why? Look at just the profit, Andre. If you had to choose between losing 11,000 or losing 26,000, which one would you rather lose?
11,000.
Right, exactly. Yep. So maybe we should continue the brand Flakes. I don't want to. I agree with you, Andre. I'd rather not do it because I think, business operating strategy wise, I would discontinue. But in terms of mitigating our loss, I'd rather lose 11,000 than 26,000. So, having said that, we should probably continue the brand Flakes until we get something else going. But you can see how this type of decision making has an impact on the business. While yes, the brand Flakes still generates a loss for the company of 11,000, it's still best to lose 11,000 instead of 26. So based on that type of decision,
Professor, I got a question.
go ahead, Andre.
How would a question like this be asked on like a final final?
Oh, that's a good question. It's a good question. So the question would probably be, well, it'd probably be two parts, would be my guess. First, you would have this data, okay? And it would say something along the lines of, which, based off of the differential analysis, it first would provide you with this data and then this data, or you would have to, or it would simply say, based off of this data, what would be the differential analysis between continuing or discontinuing the brand Flakes? So continuing, this is the data for continuing. Discontinuing, sales would be 0, variable cost would be 0, fixed cost would still be minus 20. So it will be minus 20. What did we say it was? Minus 22, minus 26. Where did the six? Oh, the fixed expense. I'm sorry. So fixed cost minus 20, fixed expense would still be minus 6. So if we continue the brand Flakes, this is what it looks like. If we discontinue it, sales goes to 0, all the variable costs go to 0, but the fixed costs remain the same because fixed costs do not change regardless of the level of output. So because of that principle, we have fixed costs at minus 26,000 and all else remaining 0. So my operating loss would be minus 26,000 versus the current loss of 11,000. So the question might be, based off this differential analysis that you've just completed, what is the best alternative, one or two? And of course, it would be one because we would lose the least with alternative one. Does that make sense, Andre?
Oh, now I'm kind of seeing it. I'm seeing that the parentheses mean negative. I'm
Yes,
forgetting that
sir.
sometimes parentheses mean negative.
Parentheses mean negative. You got it. Parentheses means loss or minus or negative. Yeah, you got it. You said it right. Parentheses means negative. Yep.
No, you're saying that if we wanted to continue it, but we would have to place something in this position.
Eventually, eventually. I mean, if you really wanted to continue the discussion further, I would tell the company continue the brand Flakes until you find a more profitable product to replace it with later on. But don't worry, you won't have to make that type of decision on the test. But it's just it helps that kind of conversation helps us to make better decisions as managers. So Very good.
Thank you.
Absolutely. Good discussion. Okay, now another fun differential analysis topic, the make or buy decision. In manufacturing, we have two options. We can either make the product ourselves or we can buy it from a supplier and then sell it, right? So the concept of differential analysis, which is the decision between two alternatives, can help us in this process. So let's look at it from an example. Let's say we have or let's say we have our example is we have we're an auto manufacturer, and we can make or buy the instrument panel. Instrument panel is, the gauges on the steering wheel that tell you how fast you're going, all that stuff, right? RPMs, all that stuff. We can either make those or we can buy those. Now let's look at the difference. We can buy it already assembled for $240 a unit. Right now, our company is operating at 80% capacity, okay? With no major increase in production in the near future. The current cost of manufacturing the instrument panels is following. We have direct materials, $80. Direct labor, $80. Variable factory overhead, $52. Fixed factory overhead, $68, giving us a total cost per unit of $280. Okay, so let's look at the alternative. Now, how do we find the alternative? We look at the difference. Purchase price for alternative one is 0 because we're making that one in-house, but we have direct materials, direct labor, factory overhead. Direct materials, direct labor, variable factory overhead, plus fixed factory overhead gives us a total cost of $280 to manufacture it. Now, earlier I had said that the purchase price to purchase the completed unit and install it is $240. But, as I said very early on, fixed factory overhead does not change regardless of output. So, in the buy decision, the purchase price is $240. The fixed factory overhead still $68. That part doesn't change. I still got to pay that, whether I decide to make it or buy it. So that means my total purchase price per unit is $308. So, who wants to answer the question? Do we make it or do we buy it, and why? Remember, my capacity is at 80%, and I have no reasonable belief that it'll increase above that 80% capacity. So do I make it or do I buy it?
You would make it
You
alternative
will
one.
make it, Professor.
Yeah, absolutely I would make it. I'd make that all day long. It's a difference of $28.
Mm-hmm.
Yeah, I totally agree with you. I would definitely make it in this decision. Now again, as we go through differential analysis, we look at the difference across, right? And so 0 to 40, difference 240. 80, 0, difference 80, 80, 0, difference 80, 52, 0, difference 52, 68, 68, difference 0. If we go down, minus 240 plus 80 plus 80 plus 52 is minus 28. That means the difference in total cost is $28. So it's minus 28, which tells me that if it's based off of alternative 2, alternative 1 is the right decision. If that number were positive instead of negative, alternative 2 would be the better option. So, yes, I agree with all of you. Making it is the best alternative, especially if my capacity is only at 80%. However, if my factory capacity were at 100%, meaning there's no way I could take on more responsibility of manufacturing in my facility, then the correct response would have been alternative two, even if the cost was higher. Because you have to remember, when we're manufacturing, you have to take into consideration capacity to manufacture. Okay, another fun, interesting decision, and I've had to make this decision myself. And I think did I tell you all the decision I had to make at the hotel a long time ago when the chiller broke? I told you all about that, right?
I don't remember you saying that.
You don't remember the story? Okay.
No, did I miss
I
it?
think you told us in accounting one, Professor.
Did I tell you in accounting one? Okay, well,
You did.
I'll tell you it again in accounting two. So, so here's what happened, and this is the type of decision we would make, and it's just like this, okay? So what happened is, and you all know me, I got a lot of experience in the business. I'm a hospitality guy, just like a lot of you are, and so I was a financial controller, the chief accountant, right, for a hotel. And it was the second largest hotel in New York State. We had 700, well, it was like 685 guest rooms, 30,000 square feet of banquet space, 20-story building, million square feet total. A big, big building, yeah? And so we had this thing on the roof. It's called a chiller. Big buildings have these things called chillers, okay? It's exactly what it sounds like. It chills. It makes you feel nice and cold, especially during the winter months. Oh, I'm sorry, during the summer months. A chiller is like a big giant air condensing unit. Okay, and it operates all of the air conditioners in the hotel. That's what makes it cold. Yeah. So one day, the chief engineer, engineer is a fancy term for the chief repair guy, right? He's in charge of all maintenance and repairs for the hotel. So he comes to me and he goes, "Hey, B, the chiller's about to break." I go, "Hmm." I go, "What's a chiller?" And he explained to me what a chiller is. And I go, "It sounds expensive." Because I'm the money guy, right? I go, "How much does a chiller cost?" He goes, "Oh, 280 million." And I looked at him like,
Hey, Professor, that's a lot of money.
it was a lot of money. So I
That's a
looked
lot
at
of
him,
money.
I'm like, pardon? He goes, yeah. He goes, it runs for the whole building. I go, oh, okay. I go, well, that's a lot of money. I said, we don't have that kind of money. I said, we can probably raise it, but, that's going to take some time. And he goes, yep. And I said, well, how much will it cost us to repair it? He goes, well, we could probably get away with repairing it for about 47 million. So, okay, well, that's a lot better. I said, but if we repair it, how much longer do you think it'll last? He goes, well, it depends. He goes, the chiller's 30 some odd years old. I said, well, how long do they normally last? He goes, about 25 years. I said, well, okay. I said, we need to do a differential analysis. And so that's exactly what we did. We priced everything out. We looked at the differences. Ultimately, we ended up getting a new chiller, but we ended up spreading the cost over about 15 years. So that way, it didn't kill us. Otherwise, we would have had some serious financial problems. And to answer, some of you might be asking, well, what was the revenue at that hotel? We pulled in about $330 million a year. So a good sized operation, to say the least. Anyway, that's my story. And so we had to do this thing called differential analysis for repair or replace. And that's exactly what this part tells us to do. Okay, so here's how it works. Obviously, much smaller scale, but just throw a couple of zeros on it, right? Let's assume we're looking to replace an old machine with a new machine. The old machine, what's it currently worth? Book value, 100,000. Okay. worth 100,000 currently. The estimated annual variable manufacturing cost 225,000. Estimated selling price 25,000. Estimated remaining useful life 5 years. Okay. So what this tells me is it's currently worth 100,000. Variable manufacturing cost 225. Estimated selling price 25,000. So if I sell it, I can get 25% of its book value. I don't know. Okay, so now let's look at the price of a new machine. New machine price 250,000. Oh, that's a big chunk of change up front. Estimated annual variable manufacturing cost 150,000. Okay. Residual value 0. Estimated useful life 5 years. Okay, well this is interesting. Estimated useful life remaining 5 years. Estimated useful life of a new machine 5 years. Let's do the differential analysis. So here we go. Current machine, proceeds from the sale. Well, if I keep using it, it's going to cost me, my revenue would be 0 because I'm not going to sell it. My costs, purchase price will be 0 because I'm not buying a new machine. The variable manufacturing cost for 5 years is 1,125,000. Okay, so in other words, if I keep the machine, my operating cost for the remaining 5 years of its useful life is 1,125,000. Alternative 2, we purchase a new machine by selling the old one first. If I sell the old one, I could get 25,000, right? The purchase price of the new machine is 250,000. The cost of operating for 5 years, 750,000. So that gives me a total loss of 975,000. What do we think? Do we buy a new machine or not? What would you all want to do? And why? I'm making this fun, right? What one would you all want to do? Do you want to buy a new machine or no?
I think that I'm gonna take a stab at it. I was thinking sell the old machine first, alternative 2,
So you like alternative 2? That's a good alternative. Why is that? Why do you think that's a good idea?
because I feel like you still the 750 like you gonna that's 5 years, so it will be more not of a hit for the 9,775.
That's a good logical explanation. I really like that one a lot. Andre, what were you going to
How
say?
many years
Yeah,
will
go
we
ahead.
get on the replacement one? I mean, well, the one if you repair it. Is it the same
I'm
amount of years?
sorry. I'm sorry, Tamika. Can you say that again, please?
Will you get the same amount of years
Yep.
as
Same
far
amount of
as
years. It'll be 5 years.
um,
Yep, absolutely. So what do you think, Tamika?
I'm gonna say take the 975.
I'm with you on that. I'm with you on
If it's
that.
gonna give me the same amount of years, I'm gonna take
I know that's right.
975.
I would rather lose 975 than lose 1,225,000 over 5 years. I agree. Andre, what do you think?
I think it's best to replace the old machine with a new machine because your bottom line is showing that you're actually paying a lot less for a newer model of the machine than keeping and updating the the old machine that we currently have.
I agree with you, and that is excellent logic as well. And another way to, if you really wanted to get technical with this decision, we see that the variable manufacturing costs, 750,000 if we replace the machine versus the 1.125 million. If you spread that over 5 years, even with the purchase price of $250,000 upfront in that first year, you're still making out good over a 5-year period. So I'm with all of you on this decision. I would agree it makes the most sense to replace replace the old machine with a new one. Of course, sell that old one for $25,000. Come on. Yeah, very good, very good. And in making that decision, we look at this thing called opportunity cost. Hopefully, you've heard the term opportunity cost before. Where you might have heard it before would have been in your Introduction to Business course. Opportunity cost is the cost foregone. Foregone. That's what the word opportunity means. It's the alternative cost, right? That you forego. Revenue that is foregone is called an alternative use of an asset, such as cash, is called an opportunity cost. Now, we do not record opportunity costs in accounting, but we do use opportunity costs in decision making. You're not going to see an account called opportunity cost. That doesn't exist. It's not a real cost. It's the cost of the decision, not a true cost. If that makes sense. There's no cash involved. An alternative cost. It's only for decision-making purposes. Opportunity cost. Now, here's another decision. Here we go. This alternative analysis is called process or sell. Process or sell. Now, we learned about. Now, think way back. Okay, I want you to go back a couple of weeks to when we talked about this. Actually, way back. Like maybe week 3 or 4, I think. We talked about this concept called process cost. Remember process cost? We talked about job cost in 1 week, and then we talked about process cost in the next week. That goes back in week 3 or 4. And in that discussion, we talked about the ice cream manufacturer. That was the example that we gave. And then the ice cream manufacturer, they keep making it, right? Regardless of the sales, regardless of the customer orders, they keep making it. That's called a processor. Another example of a process company is an oil company. An oil company gets the oil out of the ground, okay, through this process of pumping the oil out of the ground. And then they put it into the trucks and they drive it over to this other place called an oil refinery. Okay, the oil refinery, hence the name refine, is they change it from crude oil that came out of the ground to different types of oil. Okay, there's automobile oil that's based off of weight that goes into your car. There is another type of refined oil called gasoline. Gasoline is what we call a derivative of oil. It comes from oil, right? Gasoline comes from oil. Oil comes from oil, different kinds of oil. There's heating oil, all different types of oil. We call these processed. Okay? It's where we take the raw material and we can process it. And then we can make a decision to process it even further. Okay? So raw oil, we process it a little bit to turn it into heating oil or automobile oil. And then if we process it even further, it can become gasoline. Okay? For fuel. And so that's the decision. Do we process it further or do we sell it as it is? Now let's look at the decision tree. This kerosene, gasoline. Kerosene is also a derivative of oil. Okay, here's how it works. Oil comes out of the ground. We take the oil from the ground to the oil refinery. The oil refinery processes it. It becomes a couple of different things, one of them being kerosene. If I process it further, it becomes gasoline. Now, as it comes out of the ground, I process it to kerosene at the refinery. If I leave it at kerosene, here's how it works. Batch size 4,000 gallons. The cost of producing the kerosene is $2,400 per batch. Obviously, a batch is 4,000 gallons. That gives me a selling price of $2.50. How did we get there? We got our batch size divided by our cost per batch, $2.50 per gallon. Okay? So we got $2.50 a gallon for kerosene. Now, let's see. Should we process it further, create gasoline? Okay, gasoline, 4,000 gallons. My output batch is 3,200 gallons. We lose through the processing. We process it further, right? First it was oil, then it was kerosene to gasoline. When I make the leap from processing it from kerosene to gasoline, I'm going to lose 20% of it through a process called evaporation. Evaporation is when the solid becomes a gas, liquid becomes a gas. I lose it through the air, through the atmosphere. Okay? That's a natural occurring process. So, 4,000 gallons, I'm going to lose 20% to evaporation. 4,000 gallons times 20% is 800 gallons. So 4,000 gallons minus 800 gallons is 3,200 gallons output. The cost of producing a batch of gasoline is $3,050. Okay. So 3,200 divided by 3,050, $3.50 a gallon selling price. Okay, how do we come up with this data? And let's look at the difference, yeah? The difference. So we got the sales price, we know the sales price. $2.50 for kerosene, $3.50 for gasoline. We anticipate revenues 10,000 a batch for kerosene, 11,200 for gasoline. How do we get that? 4,000 times $2.50 sales price for kerosene, 10,000. 3,200 gallons gasoline, 3,200 gallons gasoline output times $3.50 sales price, 11,200. Minus your cost per batch. So revenue per batch minus your cost per batch equals your profit per batch. Cost per batch kerosene, 2,040. I'm sorry, 2,400. Cost for gasoline, 3,050. Revenue minus cost equals profit. Revenue minus cost equals profit. So, in the decision to process kerosene into gasoline, which decision is best and why? What do you think?
I think the kerosene because I don't think it's that much. I think it's too much. It's not, you're not making enough a lot more profit to carry on. I think you should just stop.
I like the logic.
Proceed into gasoline.
You think gasoline, Andre?
Yes.
Okay, why?
It looks like the profit per batch is going to be over 8,000.
Per batch is higher, yep, by 550. So, interesting. Interesting. We know the prices are higher for gasoline. We know that the cost is higher for gasoline. The price is higher for gasoline. If we look at simply the difference in cost, it's $650 more for gasoline. We look at the profit difference, $550 for gasoline. So I would agree with Andre in this case. to process it further because of the higher profit. Now remember, with differential analysis, the higher the profit, the better the alternative.
Yeah, I see that now. I didn't even realize. I'm just
I
looking,
agree with your logic. I do. I agree with your logic.
but I
Um,
see,
yeah. So all about
see
the
why.
profit.
Yeah, and I'm thinking like,
Yeah, I hear you. I hear you. It's all about the profit. You know, logically, I would agree with Miss Smalls. I would say, you know what, let's not go nuts with this thing. But I agree with Mr. Robinson because, you know, company's all about profit. So yeah, I mean, that's the type of decisions we make when it comes to differential analysis. Now, here's another type of differential analysis. This one's called accept business at a special price. What this means is, let's say we produce basketballs, okay? You know, let's say we're Wilson. Yeah, we produce basketballs. That's a nice basketball, Wilson. I think they make nice basketballs. So we're Wilson. We produce basketballs for the basketball sport. And we're Wilson, so we produce basketballs and we sell it at whatever the going rate is. And we have a customer from overseas that comes to us and says, "Hey, listen, I know that you sell the basketballs at this price, but I'm willing to buy more from you at a lower price." This happens a lot in business. We call it a bulk volume discount. When a customer wants to buy more from us at a special price. Okay. And that's the decision that we're looking at. So, oh my goodness, look at me. Oh, I remember this example pretty well. So here we go. We got some data here. Currently, we're selling basketballs. We have the ability to produce 12,500. We're currently producing 10,000 basketballs. So that means we have the ability to produce another 2,500 to reach our 100% capacity. Our current sales price is $30 per basketball. I know it's steep, right? It's got to be Wilson. It's got to be Wilson. If we look at the manufacturing cost, variable cost, that's the cost of manufacturing. That's direct materials, direct labor, factory overhead, $12.50 per basketball. Our fixed costs are $7.50 per basketball, giving us a total manufacturing cost of $20 per basketball. As you can see, that is a potential profit of $10 per basketball. Sales price minus total manufacturing cost, $10 difference. Okay, so we received an order from overseas, and they want us to make 5,000 basketballs for them at $18 a piece. Production can be spread over 3 months without interfering with normal operations. So in other words, we won't go over 100% capacity. And the domestic sales price will not be affected. So if I decide to accept there's two alternatives: reject the order or accept the order. Here's the difference. 5,000 units, my current manufacturing price is $12.50 variable cost per unit. If I produce my 5,000 units at $18 per piece, my potential revenue for this order would be $90,000. My variable manufacturing cost would be $62,500, giving me a potential profit of $27,500. And when we look at this decision, It's either nothing or we get 27,500 in profit over 3 months. Well, here's the thing. Here's the thing, though. Okay. They want to give us a sales, they want to buy it from us at $18 a piece. Our current sales price domestically is $30 a piece. Our total current manufacturing cost is $20 a basketball. They want to buy it at $18 a piece. Now, based off of that data and this alternative data, what do we think? Do we make the decision to accept the offer or decline it, and why? This is a tough one. Do we accept? Do we reject? And why? Now, take into consideration the sales price would be $18 a unit. Our current sales price is $20 per unit. The total cost of manufacturing, $12.50 variable cost versus variable, actually, that's the same variable cost. We're not taking into consideration fixed cost. The fixed cost remains the same, yes? So, what do we think? There's no way I would make that decision. I mean, yes, don't get me wrong. Oh, extra 27,500 profit looks nice. That doesn't take into consideration the fixed cost. The fixed costs remain the same regardless of output, right? So, if my fixed cost is $7.50 a unit, my variable cost $12.50, looking at $20 per unit manufacturing, they want to buy it at 18? That's a solid no for me. That would be a loss of $2 per unit. But, if we only take into consideration the variable cost, which this does, then it would be accepted because it would be a $2 difference. I don't know. Personally, I would say no. It would be a no. Okay, so that's differential analysis. Any questions on differential analysis before we move on to product pricing? Another fun topic. Product pricing. We're good so far? Yeah? All right, let's do it. So, when businesses set their product sales price, we look at a lot of different things. Okay? We look at the target sales price. That means how much do I want to sell it for? Okay. We look at the normal sales price. That's like, what is the market average? What is the average price of this? And then we look at, very important that we look at this. What are our current fixed and variable costs, and can I reasonably cover them to provide a reasonable profit? In other words, we need to set the sales price high enough to cover all of our costs. Yeah. Couple of methods here for determining the market sales price. There's two market methods. One's called demand-based, the other one's called competition-based. Demand-based is exactly as it sounds. Is there enough demand in the marketplace to set the price high enough to cover our costs? An example of this. The PlayStation 5. PlayStation 5, it's the latest model of PlayStation. PlayStation is a gaming console for those of you who don't know. And this gaming console, current sales price $500. Something like that, 400 or 500, I don't know. Current sales price $500. It's currently sold out. It's been sold out for months. They get it in, it sells out. They get it in, sells out. Get it in, sells out. Clearly, the demand is there. They can easily raise that sales price to $1,000 and they'll probably still sell out. Well, maybe not quite, but they can raise it to $600, they'll probably still sell out. They raise it to $750, it might not sell out, but they could still sell a lot of it. What this tells us, what this example tells us, and you do the same example with like iPhones and whatever product. If the demand is high, you can set the price high, and people will still pay it. Absolutely. Is it wrong or immoral to do that? No. No, that's just simply supply and demand. Economics, right? If the demand is low, then we want to set the price low. So we can still sell enough of it. If the demand is low and my price is high, nobody's going to buy it. Nobody wants to buy it anyway, right? That's supply and demand. So that's what we call demand-based method for pricing your products. The other method for pricing your products is called the competition-based method. How much are your competitors selling it for? So, example of this, iPhone versus Android, right? iPhone versus Android. There's two cell phone manufacturers. You got Apple, you got Samsung. And the two compete with each other. They compete based on product. They compete based on price. Because they're competitors, right? And so typically you'll see that their prices are very close based off of the comparative models. That's competition-based pricing. The competitors, if one reduces their price, the other one reduces their price. One raises their price, the other one raises their price. Competition. Got to stay in line with competitors. For those of you in the hotel business, you know this. Look at your room rates. Your room rates in the respective markets are very similar. If your 3-star hotel is pricing a night at $120, you better believe your competitor down the street that's also a 3-star hotel probably around the same price. Because that's competition based. If one of them has a higher price than the other one, everyone's going to go to the one with the lower price. It's competition based pricing. Another method is called the cost plus method. The two we just talked about are market based. This one's called cost plus. This is one of my favorite methods. Cost plus. This is where we cover our cost, then we add in a little bit of profit. So we cover our total product cost, we cover our total cost, and we cover our variable cost. So using cost plus, there are 3 different types of methods within cost plus. Product cost method, total cost method, variable cost method. The cost plus methods, this is where we take the cost of the amount per unit and we add in the profit. That's why we call it cost plus, right? So cost plus, the plus is the markup. We cover our cost per unit plus whatever profit we want to make. And that's a very common method for pricing. And it's substantial and it helps us to generate some profit. The cost per unit, as you know, that's the manufacturing cost. Direct materials, direct labor, factory overhead, those are your total cost per unit. The plus, which is the markup, that's my desired profit, that's my estimated selling price. I'm sorry, that's my cost plus selling administrative expenses. So if I sell it for my manufacturing costs, direct materials, direct labor, factory overhead, plus selling administrative expenses, that could be my normal sales price. Or I could go manufacturing cost plus desired profit, and that would be my normal sales price. Those are the two ways to do it. And so what a lot of retailers do is they'll have their manufacturing price plus their markup. The markup will include things like administrative expenses, selling expenses, and desired profit. And that would be my desired sales price. I like that now. So how do we figure out the product cost? Direct materials plus direct labor plus factory overhead equals your total product cost. Okay. Then the next thing we do, after we have the product cost, is we estimate our sales and administrative expenses. You know, selling and administrative expenses include things like salespeople salaries, commissions, advertising and promotion. Those are all selling expenses. Administrative expenses would include things like office personnel salaries, shipping expenses, so forth and so on. Those are administrative. So once we figure out the estimate for our selling administrative expenses, the third step is to take your total product cost divided by the number of estimated units produced and sold. The fourth step is going to be compute the markup. How do you compute markup percentage? We take our desired profit plus our total selling administrative expenses divided by our total product cost. And how do you find desired profit? It's our desired return times total assets. We learned a little bit about that in the previous chapter, if I'm not mistaken. In step 5, we find our markup per unit. That's our markup percentage times the product cost per unit. Step 6, we find our sales price. Product cost per unit plus markup per unit. If we follow those 6 simple steps, we'll be able to find our sales price. So here's an example. We have direct materials, direct labor, factory overhead. Total product cost $1,500,000. Selling administrative expenses $170,000. Giving us total cost of $1,670,000. Our total assets are $800,000. And our desired return is 20%. How do we find our sales price? First thing we do, step 1, product cost $1,500,000 given to us. Selling administrative expenses, step 2, $170,000. That was given to us. Step 3, product cost per unit, $15 per unit. That was also given to us. Oh, I'm sorry. The $15 per unit was not given to us. How do we find the total cost per unit? We take our total product cost, $1,500,000, divided by the estimated units produced and sold, 100,000 units. The 100,000 units was given to us. So $1,500,000 total product cost divided by 100,000 units is $15 per unit. That's our product cost per unit. Step 4, let's find our markup percentage. To find that, we first find the desired profit, which is desired return times total assets. Desired return 20% given to us times total assets 800,000 given to us equals 160,000. Desired profit. So to find the market percentage, we'll take desired profit plus total selling administrative expenses, 160,000 plus 170,000 is 330,000, divided by total product cost, 1.5 million equals 22% desired markup percentage. Step 5, we find the markup per unit. That you take your markup percentage, 22%, times your product cost per unit, $15. That is $3.30 per unit markup. So to find your sales price, we take our product cost per unit, $15, plus our markup per unit, $3.30, giving us a total normal selling price of $18.30 per unit sales price. Fun. Another method to set your sales price is called the target costing method. And this takes market-based pricing and a cost reduction emphasis. In other words, reduce my total cost, increase my sales price. To find the target cost, we take this expected sales price minus desired profit. And this concept tries to reduce the total cost. Actual cost, target cost. Idea is reduce total cost. And how do we reduce total cost? We simplify the design, reduce cost from indirect materials, reduce cost for direct labor, eliminate waste. These are all concepts of reducing total cost. All right, let's talk about a couple of production restraints. This one's called a bottleneck. A bottleneck. Think of the top of a drinking bottle of water. Okay, the top of the bottle, the opening. It's very small. Opening is very small. The rest of the bottle is pretty large. Okay. As the water fills, the space gets smaller and smaller and smaller, and then we're constrained, right? The same concept applies in manufacturing. There is a point where demand for the product exceeds the ability to produce it. We call that a bottleneck. When demand's so high and I can't get enough of it out the door, that's a bottleneck. Okay, it's a constraint. And this leads to this thing called the theory of constraints. It's where manufacturing focuses on reducing influences on bottlenecks in order to maintain a proper production flow. When we have a bottleneck, we try to maximize our profits, because when demand is super high and we can't produce enough of it, raise the price. When we raise the price, that will cause demand to go down. We're forcing demand to go down by raising the price. And when that happens, then production can catch up with the demand. Economics.
Professor, so I got a question. So it's kind of like, if I'm not mistaken, like you kind of controlling the demand in some sense.
Yeah.
In some sense.
That's right. That's 100% right. So for those of you in the hospitality business, think of it this way. Let's say you're running a hotel, okay? And you have X number of rooms available. As the hotel fills up, what do we do with the price to slow the demand down? Raise it. And so, for example, if I have 5 rooms left out of a 120 room property, you better believe the cost of those selling price of those 5 rooms is going to be real high, because I'm trying to decrease the demand. Otherwise, I hit 100% occupancy. I mean, it's okay to hit 100% occupancy. That's totally fine to sell out. But at the same time, if you can't keep up with that demand, you raise the price. And as you raise the price, the demand will come down. Not a lot of people want to pay a whole heck of a lot for certain things. There's some things you don't have a choice, like gasoline. If gasoline shoots up to $8 a gallon tomorrow, we're still going to pay it because we have no choice. The other alternative is to drive a lot less. But
and ride a bike.
Yes,
And
get a
ride a bike.
bicycle. Exactly. Take the bus. Get a bike. But even still, there's certain things, price goes up, you still got to pay it. But for the most part, the market's relatively reasonable sometimes. Most of the time it's reasonable. Okay, another example, production bottlenecks. Okay, our company sells 3 different types of products, A, B, and C. Sales price, 130, 140, 160. Variable cost per unit is the same across all 3 products. We have a unit contribution margin, 90, 100, 120. The time it takes to treat each unit, 1 hour, 4 hours, 8 hours. Okay, obviously there's costs associated with the heating, but we'll talk about it. Unit contribution margin, very similar to what we learned about before with unit contribution margin. We take the unit contribution margin divided by hours per unit. So if we're looking at the increase in production in order to get our bottleneck straightened out, we would figure out how much it's going to take each additional hour of treatment. So we take unit contribution margin divided by the heat treatment per hours of unit in our example. And as you remember, unit contribution margin, that's your sales minus variable cost to get your unit contribution margin. Okay, so here we go. So unit contribution margin, product A, $90 divided by 1 hour, that's 90 per hour. Product B, 100 divided by 4 hours, that's $25 per hour. Product C, 120 divided by 8 hours, that's 15 per hour. So once I've figured that out, we can figure out how we would shift in order to get these rates per hour down. So as we see, the higher the price point, the lower the per hour rate is of the bottleneck. The lower the rate, the better when it comes to bottleneck. Because bottleneck, remember, it's the company's trying to keep up with demand and production. And in order to keep the product expense low for during the bottleneck situation, is we raise the price and it slows the rate. Raise the price, slows the rate. Okay, a couple of appendices I want to talk about. I'm just kind of recapping at this point. Manufacturing and selling administrative costs give you your total cost per unit, plus unit markup gives you a normal sales price. The other alternative to that is we take our total cost, which is manufacturing plus administrative plus selling, plus desired markup, desired profit, gives you your desired sales price. To find the cost, using the total cost method, we find total manufacturing cost, which, as you know, is direct materials plus direct labor plus direct factory overhead, gets you total manufacturing cost. Step 2, we find our selling administrative expenses. Step 3, we get our total manufacturing cost plus our selling administrative to get total cost. Step 4, we take total cost divided by estimated units of production sold. Again, we're just recapping, that's why we're going fast. Step 5, we find markup percentage, desired profit divided by total cost. Find desired profit, we take desired return times total assets. Step 6, take markup percentage times total cost per unit. Step 7, we find our sales price by taking total cost per unit plus markup per unit. It's our sales price. Again, it's the same data from before. We're just recapping, right? So that's the reason why I'm showing you this again. You're probably like, Dr. B, we just saw this. I'm trying to drill it into you, right? Sales price, same as before. Okay. Variable cost per unit, to find that we take variable manufacturing cost plus variable selling administrative expenses plus markup equals our sales price. What is markup? Markup would include fixed manufacturing cost plus fixed selling administrative expenses plus desired profit. Markup would include total fixed costs and desired profit. Variable costs would include variable manufacturing, variable selling administrative. Add those two together to get your desired sales price. And under this method, we have direct materials, direct labor, and variable factory overhead to get you total variable product cost. It's the same exact principles that we learned in the previous chapter. Estimate the variable selling administrative expenses. Second step. Third step, determine variable selling cost. We take total variable product cost plus total variable selling administrative expenses to get total variable cost. Step 4, total variable cost divided by estimated units of production. Step 5, we find our markup percentage, desired profit plus total fixed administrative expenses divided by total variable cost. To find desired profit, we take desired return times total assets. Step 6, take markup percentage times variable cost per unit. Step 7, we take the variable cost per unit plus the markup per unit to get our normal sales price using the variable cost method. And using that same data, we go through each step. Variable cost per unit, $16 per unit. Normal sales price, $18.30. Last concept I want to talk about, yield. The word yield is what's extra, what's difference. Yield. Yield pricing is accepting business at a special price through differential analysis. That's yield. So let's look at an example, airline example. We have fixed costs and variable costs. Fixed costs include plane depreciation, crew salaries, fuel, ground salaries, airport fees. Okay. The variable cost per passenger, fuel, ground salaries, passenger services. So looking at our fixed cost per flight, $18,400. Our variable cost per passenger is $35. Looking at our example, we can find the contribution margin per passenger. You can do the same thing for the hotel business, right? You could take the building depreciation, employee salaries, utilities, other salaries, right? It's the same concept, same concept. But to find the cost per passenger per guest, find the ticket price. That's how much you bought the airline ticket for, or the hotel room night for, minus the variable cost per guest or per customer. Our example, the variable cost per passenger is $35. We find the $35. We add up all of our cost per passenger. Do the same thing for guests, right? Sales ticket price minus variable cost per passenger, $115 per passenger. Let's say we have an airplane that has a capacity of 200 seats. Well, 170 seats have already been sold at an average ticket price of $150. So if we sell for $150, variable cost $35, it's $115 per passenger of contribution margin, and we sold 170 seats already. If it's a 200-person plane, to break even, we take our fixed cost divided by contribution margin per passenger, or unit contribution margin. So 18,400 divided by 115. That I need to sell 160 seats at $150 in order to break even. So as long as I sell 160 seats, I can break even. Selling them at $150 a piece. and I'm pretty sure we talked a lot about break even last week. How do we sell the other 30 seats that we haven't sold yet? Well, we could either put it on discount to fill the flight, or if the demand is already there, you could even raise the price. But if you want to fill the flight and you've already broken even, you could put it on discount. Right? So you have a sale, 50% off, pretty good deal. $75 a ticket, minus variable cost per passenger, contribution margin on the remaining seats, $40 per seat. Times any standby passengers per flight, income for standby passengers. You get a lot of data out of this information. So the reason why I showed you the yield concept is yield means the additional that you get, right? And so because of that, we can find any type of additional revenue from selling more. That's kind of the concept behind pricing. Any questions about setting sales prices or differential analysis? Are we good? Everyone knows what you need to do for this week? Any questions at all? We're good? Okay. So as a reminder, we are currently in week 13. Oh my goodness, week 13. Time is flying by. So we've reached the end of module 3. This week you'll have a discussion board. Every discussion board, it is very critical that you participate. Each discussion board is worth 5% of your total grade. There are 4 discussion boards in this course. That means it's 20% of your grade is in discussion boards. If you do not participate in discussion boards, there's no chance you'll be able to pass this course. Very unlikely. You'd have to ace everything else in order to even get a B. Or no, a C. So, okay. So, what does that mean? Participate in the discussion board? Yes. Okay, chapter 25 discussion board. At least one full paragraph response. Minimum. Try to do about 150 words or so, paragraph response to the discussion prompt. Then, please respond to 2 or more of your classmates with full paragraphs. That's a good job, nice work, oh, that's so cute. No, you get 0 for those types of responses. Those are not responses. Please type full paragraphs and both responding to the original discussion question and full paragraphs for each response to your 2 or more classmates. Sound good? Makes sense? Any questions? We're good? Okay. Well,
Yeah, I'm good, Professor.
awesome.
Thanks.
Thank you, Ms. Smalls. I appreciate you. If you think of anything, need any help, anything at all, you know how to get me. You got my phone number. You got my email address. You could set up office hours with me. You know I respond very quickly to your emails. But other than that, you got me. I'm here for you 100% of the time. So if you have any comments, questions, concerns along the way, just feel free to shoot me a quick note and I'll get back to you. In addition to that, I hope you all have a wonderful rest of your evening. And you know what I'm about to say.
Wash
Stay
your
safe.
hands.
Wash your hands. Do the right things. Thank you all so very much for your time and have a wonderful evening. Thank you. Good night.
Thank you, Professor. Have a good evening.
Take
Thank
care.
you. Have a good evening.
All right.
Have a good evening.
Always a pleasure. Thank you so much.
Have a good night.
You too. Take care. Bye-bye.